silver is like a canary in the coal mine for the system. They're going to keep trying, but I think, as I said, there's people who want the real thing, and that's going to make it more and more difficult for them to keep things under wraps. And I thought we'd get to 40 a lot quicker, but yeah, there's always a way for them to kind of delay things. The options expiry always seem to be like a time period where they come after trying to protect strike prices. And I think the next one is August for silver's somewhere August 28th. So who knows? We could see some fireworks before then to the upside.
Markets have short memories, but the metals market keeps receipts. Gold's been stuck between $3,200 and $3,400, not because it's weak, but because it's building pressure. Veteran analyst Mario Innecco doesn't see this range as resistance. He sees it as groundwork. According to Innecco, gold has already redefined its foundation. Before 2024, he had been watching a long-term trend line that dated back to the 1970s. That line put $2,700 as the key threshold, and gold didn't just break it, it came back to test it, and held. Now, anywhere between $2,700 and $3,000 appears to be solid support. That's the floor. The ceiling? We haven't seen it yet. What could light the fuse? Economic stress, political noise. Trump is possibly announcing his Fed pick months ahead of schedule, or any number of global tensions flaring up again. The point is, the market is primed, and it won't take much. Silver's story mirrors gold's, but with more volatility and more interference. Innecco pegs $30 as the new floor. He admits it's bold, given how easily bullion banks still manipulate silver prices, but the dynamics are changing. China isn't speculating. They're accumulating real metal for real-world use. That physical demand is what eventually breaks the paper games. And those paper games? Still very much alive. Innecco points to the LBMA and COMEX, particularly the EFP mechanism, which is intended to bridge the futures and physical markets. In practice, it's just more synthetic hedging. The paper market continues to price silver as if it were an abundant resource. The physical market says otherwise. The takeaway? Gold's base is solid, silver's floor is rising, and the disconnect between real and synthetic is no longer just an academic issue. It's a market fault line, and at some point, it's going to snap. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Yeah, I mean, gold has been, of course, outperforming silver. 2-3 years ago, if you told me gold would be where it is now, I would have thought silver would be way over 40, maybe even making new highs. So silver has caught up a little bit in the last month or two with gold. We've broken back below that 100 level gold-silver ratio. And I think last week it was the usual suspects, options expiry. So they smacked gold and silver. But I think they've rebounded quite well in the last couple of days, especially after the jobs numbers we saw on Friday. I think gold, we reached that 3,500 level back in April. So we've been consolidating basically between 32 and 3,400. And I think we're close to a level or to a juncture where I could see gold taking off again, and silver will take off as well, I think. And technically looks pretty good. What will cause it is difficult to say. Could be the economy, could be Trump and his fight against Jay Powell. I heard he's going to nominate the new chairman, I think very soon this week or something, even though they can only take over in May. But just coming out with a name might spur things along. And also geopolitically, Chris, I think there's a lot of trouble out there geopolitically, and it looks like again Trump has gone from someone who is pushing for peace to someone who's looking quite belligerent for now. I guess 3,000 looks like a very good base now for gold. Before like 2024, I was still really bullish gold, and I had this trend line that I drew from like the 70s on the logarithmic chart, and it gave me 2,700 as a key level going forward. And we went towards that level. We broke above it, and then after the election, after November 5th, 2024, gold corrected quite sharply, and I think it went back to like 2,300 or so. So I think we've retested that trend line where 2,700 was the key level, but now that line is going up. So I suspect anywhere between 2,700 and 3,000 will be a floor now for gold. For silver, I'd say 30. I don't think if I had to guess or prognosticate, it would be the base now would be 30 for silver. I don't see it. I mean, you never know with the bullion banks, they can try and do anything, but I think it's getting harder and harder for them to throw paper at the market, mainly because countries like China, they need the real thing, like you have on behind you there. They don't need paper, they need real silver to develop their infrastructure. I mean, they have a huge country, a huge economy, and they're growing and they need a lot of silver. So I think the paper boys are going to be in trouble. They need to run for the hills and cover their shorts. I've spoken with Eric Young, King Kong, and he's done a lot of research on the EFP situation. And yes, it's hedged against the EFP, exchange for physical, on the LBMA. But at the same time, it's almost as if they're not really trading physical. EFP stands for exchange for physical. So yeah, they might be hedging, but they're hedging paper. They're not really hedging real physical silver. And I think that's the problem. And I try to, I mean, just keep an eye on price and technicals. I don't really look that closely at open interest, COMEX, LBMA, because I think eventually, Chris, demand for real physical silver is gonna overwhelm these paper shenanigans. And I still think it's paper shenanigans. You know, why should banks have such huge positions in silver? I mean, we haven't used silver as money since the 60s. So there's no excuse for them to be doing that. And I don't really think, yeah, to say they're hedging for producers is a little bit of a stretch. I think they're doing it for the central banks, for the Fed, Bank of England. They don't hold any silver, but silver is like a canary in the coal mine for the system. So yeah, they're going to keep trying, but I think, as I said, there's people who want the real thing, and that's going to make it more and more difficult for them to keep things under wraps. And I thought we'd get to 40 a lot quicker, but yeah, there's always a way for them to kind of delay things. The options expiry always seem to be like a time period where they come after trying to protect strike prices. And I think the next one is August for silver's somewhere August 28th. So who knows? We could see some fireworks before then to the upside. I think a lot of people think that believe that there's not that much gold left at Fort Knox, that the reason Nixon closed the gold window is because most of the gold was gone. But maybe that's one of the reasons why there's so much. I think the COMEX deliveries this year are up massively compared to last year. So maybe they came out with the audit thing. It was, I think Elon Musk started asking it, and then Trump asked for it, and then Besant went to them and said, "Shut up! We can't. We need to get the gold first before we can do an audit." So maybe it's the U.S. government that's taking all the physical out of COMEX, or there's a lot of physical gold going into the US as well, late last year and early this year. So who knows? But yeah, like you said, that's gone off the radar. The audit. I guess now they're trying. They said a lot of things that is they're trying to get off the radar. I'm not gonna get into that guy who Jeffrey, the Jeffrey guy, Epstein.
Mario Innecco points out something most analysts are missing. Tariffs may be quietly undermining the US dollar. He explains that when the US slaps tariffs on imports, it isn't punishing foreign exporters, it's taxing Americans. But the broader consequence is a slowdown in international trade. Fewer imports mean fewer dollars flowing out to the world. And when foreign companies earn fewer dollars, they buy fewer US assets, including treasuries. That chips away at global demand for the dollar. And as Innecco notes, the dollar index is starting to reflect that shift. He says the US is turning inward, trying to become more self-reliant. Politically, that sounds strong. But in reality, it reduces the global need to transact in dollars, and that's not bullish for the currency. Innecco also points to a contradiction in Trump's messaging. On the one hand, he advocates for a strong dollar. On the other hand, he admits that the US benefits more from a weak one. That's not a gaffe, it's a strategy. A weaker dollar boosts exports, reduces the trade deficit, and helps domestic producers. It's consistent with Trump's push for lower interest rates, with some reports suggesting he wants the Fed to cut down to 1%. But here's what's strange. The dollar isn't rising, even though the Fed has held rates steady while other central banks, like the ECB, the Bank of England, and the Swiss National Bank, have already started easing. According to Innecco, the market should be favoring the dollar. The fact that it's not tells you everything. Let's get back to the interview.
I think one of the reasons the dollar's coming down, and I haven't heard many people speak about this, and I could be wrong, someone might want to correct me, is that if you impose tariffs on imports, and I say that because Trump seems to think that the tariffs are on the countries that sell this stuff, and it's not. But if you do that, you're going to cut out a lot of the foreign trade that the U.S. does. And what that's going to do, that means, foreigners are not going to be receiving as many dollars as they used to, because they're not going to be selling as much to the U.S. So what happens there, Chris, is that they will have less demand for treasuries and dollars. So I think that's what the dollar index is forecasting, that, the U.S. is going to become a lot more autarkic. That's a strange word, but it means that you are more self-sufficient. And if that happens, why will countries need to use the dollar, right? Because America is going to close its doors to foreign goods. I think that's one of the reasons. But and I think that they're also trying to weaken the dollar. Like you said, Trump said he likes the sound of a strong dollar, but he said we make a hell of a lot more money with a weak dollar. So so that's what's going on. And I think and it's true that that's the only reason the U.S. has been running a huge trade and current account deficits, because the dollar is too strong. But at the same time, he wants the Fed to cut rates down to 1. That would probably do the trick, because if anything, the dollar should be going up in this year, because the ECB has been cutting, the Bank of England has been cutting, the Swiss have been cutting, and the Fed's held pat. So I think it's the trade policy of Trump that's pushing the dollar lower, and I don't think they have a problem with that, because I remember, or I don't remember, but I know the history. Back in 67 or 68, the Chancellor of the Exchequer here in the UK, he said, we're going to devalue the pound, but the pound in your pocket is still the same. They try to fool the public. And I think Nixon as well when he made his announcement on August 15th, 1971, he said, well, the dollar is going to be the same at home. It's just going to be a little more expensive if you go abroad. So I think that's the way they're looking at it. And well, that's bullish for anything that's not the dollar, especially precious metals. But unfortunately, Chris, I think a lot of people, the vast majority of the public, they don't understand that, and they're gonna be left holding the bag of rapidly depreciating fiat dollars, and they're already doing so because, like you showed there, the dollar's lost 10% this year versus fiat currencies that aren't that much better than the dollar, if anything worse. I mean, the 73,000 number is actually was the expectation. Because I always look at that before the numbers come out, because having worked in the markets, what the markets expect and what comes out is really important to determine what the market will do on that day. And so the expectation was 100 or 110,000. So it wasn't that bad of a miss. And 100,000 already is not really a great economy. I think the US needs over 200,000 non-farm payroll additions every month to keep up with the demographic situation. So, yeah. I think what he didn't like were the revisions for the previous 2 months, which dropped, resulted in a subtraction of like 258,000. But like you said, these numbers, they're just like surveys, and they extrapolate from the surveys how much non-farm payrolls went up. So is he also going to complain about CPI, that they've doctored CPI since the 1980s and it should be more like 10 or 12%? I'm sure he won't. I'm sure you'll find a way to make it look even lower. So, yeah, I think it's a bad precedent. And I saw Professor Stephen Hanke just before we came on, because he says some interesting stuff, and he was on like a TV, and someone asked him about that, and he said, well, it's like the Potomac, Caracas on the Potomac. It's the kind of stuff that Maduro would do, sack his statistics, the head of the statistics market. So, yeah, I don't think it's a good thing. Yeah, but I guess it gives Trump a bit of a cover. He wants to find if the economy slows down, he can say, oh, well, it was this that happened. It wasn't me, you know. So it's I never thought a president would do that after a weak number, to come out and on the day and say, I'm going to sack the head of the BLS. You could at least wait maybe a couple of weeks and ask the head to like resign because of personal reasons or something, make it a little bit less obvious.
This isn't a typical consolidation phase. Gold hovering between $3,200 and $3,400 isn't hesitation, it's recalibration. What looks like indecision on the chart is, in reality, a reset of what counts as usual in a market that's been flipped inside out. The decades-long trend lines have shifted. The old ceilings are now floors. And while central banks and bullion banks continue their dance with paper leverage, the physical market is getting louder, whether through Asia's accumulation, sovereign stockpiles, or dwindling vault inventories. Meanwhile, the dollar's position as the world's anchor currency is showing hairline fractures. Tariffs, once dismissed as trade policy fluff, are starting to echo through capital flows and reserve strategies. It's not just about inflation anymore, it's about trust. In institutions, in currencies, in systems that no longer reflect the underlying economic reality. So when gold quietly refuses to fall, when silver shrugs off manipulation attempts, when the dollar weakens despite rate differentials in its favor, what are these markets trying to say? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.